what we're also seeing, though, is a real increased focus on the tax advantage of the employer benefits. And so what I wanted to do is show an example of the advantage of using of buying insurance through the employer. Because I've had, with that said, a lot of employers, when I meet with them, they're like, well, what if I just give everybody the money, tell them to go buy their own insurance through the exchange? In the past, individual market wasn't guarantee issued, so a lot of employers wouldn't do that because they're concerned that some of their employees would be denied insurance. With healthcare reform, nobody gets denied insurance anymore, so that's not a concern. So employers that maybe weren't canceling their plan because of that now don't have to worry about it. But what I've been walking through with a lot of employers is this tax difference. There's very, very big tax advantages of buying coverage through an employer. So this slide kind of sums it up. And what I did is a real typical situation here where I'm comparing a plan here that on the site on the left side here is employer-sponsored coverage. And so I'm assuming that the employer can find a plan that costs $400 for single coverage, and they're paying 75% of the premium. Okay, so the employer is paying $300, the employee is paying $100, and that's the cost. And that's really common. A lot of employers pay 75% of the cost of the insurance, and $400 is somewhat of an average premium, although that keeps going up every year. So when we do it through the employer, there's no taxes. So of the $300 that the employer is paying for benefits, none of that's taxed for FICA. None of that's taxed for income. It's not taxable income to the employees. So that full $300 goes toward paying for insurance. There's no taxes coming out of that. And then the employee has to pay $100 out of their paycheck. That gets payroll deducted, but we always set up a Section 125 premium-only plan. That $100 from their paycheck comes out pre-tax. That usually saves them about $33 in taxes. So the net cost on that plan is $67 a month. If we go to the individual market, and this is a big assumption because it never works out this way, but I'm assuming we're going to find the same plan, the same price, because that doesn't really work because the individual market's age-rated, where a lot of times the employer market's not. But assuming we're able to find the same plan, same price, so we could do the tax calculation, and the employer wants to use the same budget, so they're like, hey, I paid $300 here, I'm going to pay $300 on the individual market. This is essentially saying, hey, we're going to drop the group plan and give everybody $300. So when we do that, what actually happens is the employer, that $300 budget only gives the employee $277 because the employer has to withhold FICA on that, the $23, 7.65%. Okay, and then that $277 that's left over gets taxed both FICA and income to the employee. So we pull another $90 out of that. So that leaves $187 left available for insurance. So they took a big hit on the taxes there. And then the employee then, to buy that $400 policy, they need to come up with $213 take-home pay to go along with that to get to the $400. And to get another $213 take-home, they have to earn $316. So they have to earn $316 to net the $213 to add to the $187 to get to the $400. So in this example, and this is an employee with a 25% tax bracket, 7.65% FICA, they have to, the net cost to the employee almost quadruples just on taxes alone. So this here is a huge reason why employers aren't dropping in coverage. The lowest income employees, obviously, they might not be paying much taxes. They might be eligible for subsidies through the exchange. So this equation doesn't work out the same way. They might actually be just fine if the employer drops the coverage. But for the higher skilled employees that are making, better wages, more key employees, or just kind of depends on your average wages, it could be just your average employee, is going to get hit with a huge tax difference. And if they have family coverage, then this just gets amplified. So so this is, like as I mentioned, this is a good kind of thought exercise to go through, and we've just been educating a lot of people on this, how this works. Another trend for 2015 is narrow networks. So in Washington, we've been pretty lucky that most all plans we've been showing, with the exception of group health, have had very, very large networks. So in the past, you're looking at Regence, Premera, Aetna, United Healthcare, Cigna. I know I'm skipping some. Most of those, everyone was concerned that their doctor be in the network, but when you look it up, most everyone doctor was on the network because most all the plans had large networks. The one exception was group health HMO, where everybody kind of knew, well, that's group health. You go to group health if you want that plan. And with some exceptions, that's kind of how it's been working. So with the big focus on keeping costs down and some things in healthcare reform, a lot of the insurance companies like Premera and Regence and Aetna, who had traditionally just offered one large network, are now starting to offer smaller networks in a means to help drive the cost of healthcare down. So offering less selection for employees, but price savings. So most of the carriers are doing this in an employee choice scenario. So I think the best example would be what Aetna is doing in 2015. What they're doing is there's essentially 5 different networks that an employee can choose from. So they have their plans, like you can get the 1,000 deductible or the 2,000 deductible. But once you decide which plan you want from an employee perspective, let's say the employee wants the 1,000 deductible, then the employee can choose, do I want the traditional large network? It's called the Open Choice PPO, which includes all of the hospitals and all the doctors in the state. Or for 10% lower premium, am I willing to go with a smaller network? And in the Aetna example, they've gone out to 4 different provider groups: Polyclinic, Franciscan down in Tacoma, Swedish Providence, and PacMed. So if an employee wanted to say, if they were like, hey, I want to go with just Polyclinic doctors as the in-network, they could do that, and then they'd be required to only go to Polyclinic, otherwise they get out-of-network benefits. But for limiting the choice that they have, they could get a 10% savings. So that's really kind of a new thing. Aetna is doing that. Regence is also doing that with a they're working with MultiCare, I think UW and a few other. The Regence premium savings aren't quite as big. I think with MultiCare, they're saying you save like 3%, so it's not quite as compelling as this 10% Aetna's getting. And then United Healthcare is also doing something similar, but their narrow network is more like an HMO, so requires some referrals and that kind of thing as well. So anyway, that's a trend that we're seeing as far as getting employees to have the option of not only higher or lower deductible, but also smaller or larger network. The other thing we're seeing a lot of, and we've been doing a lot of this in the past 3 or 4 years, but it keeps expanding, is known as private exchanges or just multiple plan option. So what that means is a small company offering, instead of just saying, hey, here's your one plan, it's a 500 deductible plan, and it's going to cost you $50 a month, for example. An employer, a lot of them are offering 3 different plans. Here you can do the 500 deductible plan, 1,000, or the 1,500 deductible. And we're going to pay $400 an employee, and you employee get to decide if you want to get with the more expensive plan, the lower expensive plan, and so forth. So that's a really good, a lot of employers are taking advantage of that, giving the employees more choice on exactly how they can use their employee benefit dollars. And by doing it this way, keeping it in a group plan, you still get all the group tax benefits. So for the employer that comes to me and says, hey, I just want to give everybody money to go buy their own plan, what we do is we say, okay, we can do that, but let's keep it within the group within a group plan. That way everybody gets a tax advantage. You don't have to worry about all the taxes coming out of it. So this has been popular. Large companies have been doing this forever, and more and more we can do it with smaller and smaller companies. The other trend is with association health plans. So in Washington State, about 2 years ago, about 80% of groups under 50 employees were buying their plans through associations. And we sell pretty much all the association health plans there are. You know, there's WAHID, Association of Washington Businesses, WBACC, Northwest Employers Trust, Vigilance, Building Association, AGC, all these different associations. And the reason why we're buying through the association is there were some loopholes that allow the associations to have rating flexibility and essentially get better rates to healthier groups. With healthcare reform, the laws and rules and regulations around associations and which ones are considered true group or bona fide or not have been changed, and they're up for interpretation. So right now it's kind of a unique situation. Each association is operating under their own interpretation of federal law. The feds have not come down and come into Washington State and said exactly which association or, you know, how associations can or cannot work. So right now we have a situation where the association and health plans are continuing to do business as usual. Most of them, some of them closed, some of them have changed the way that they rate and so forth. But there hasn't really been any federal government coming in and giving some stamp of approval. The insurance commissioner has been out there kind of explaining what he believes the federal law should, how it reads, and how associations should behave or should not behave, and that has been and he's been talking about things and making some rulings. And so essentially I think that what we're finding is we're probably going to find that the association health plans in Washington State, how exactly they are able to rate and who, you know, and function is going to most likely be decided in the courts. So we don't see anything changing with the associations that are still around in the very near term, but we do anticipate some sort of court action or decision being made, because right now most all the association health plans, I'd say pretty much all of them, are not following the insurance commissioner's directions to a T. And so the insurance commissioner is most likely going to come after most associations saying, hey, you need to change the way you do business. The associations are referring to the federal law, and they're saying, hey, we're following the federal law. And so essentially Department of Labor will have to get involved at some point and decide exactly how this is going to work. So for now, we'll just keep an eye on it, continue to work with association health plans, and anything that were to change would take months and months to change. We're not going to see a situation where anything gets canceled or retroactively, you know, people don't have coverage or anything like that. So that's a little bit about association health plans. And then the final thing I want to talk about is small group self-funded plans. So what we're finding is there's a major loophole in the healthcare reform law that said if you self-insure your health plan, you can get out of paying the insurance company tax. That's that $8 billion tax, or the 2.9%. There's a lot of state insurance taxes, about 1% or 2%. You don't have to do community rating, so you can give discounts for healthy groups, and you can avoid many of the state mandates by essentially being a self-insured medical plan. So how self-funding works is typically there's an insurance company or third-party administrator that handles all the claims processing. So to the employees and the employer, it's just like a normal plan. You know, the employer pays a monthly premium. The employees have an insurance card. They pay their co-pays or they have their deductibles and so forth. But on the back end, the contracts showed that the employers billed for claims up to a stop loss, and then the insurance pays for claims over the stop loss. For most small group self-funded plans, the employer just pays a maximum premium every month. They'll just pay one fixed premium every month. And then what happens is if they have low claims, they will actually get a refund. So if their claims come in under the stop loss, they'll actually get a refund or a credit for the next year. And by doing that, it makes it considered a self-funded plan for the respective health reform. However, from the employer perspective, there's not really risk because they're paying essentially the worst case scenario. So if the claims are really high at the end of the year, they don't owe any money. They would just, wouldn't get refund potential or credit for the next year. The one thing about these self-funded plans is most of them do require employees to do individual health statements. So they're really only good options for groups that are pretty healthy. So if you're a company that thinks, hey, our claims are good, we're in the fully insured market, we're being overcharged because our employees don't really use a plan that much and they don't have major medical issues, then this self-funded option is a very attractive option. For companies that have large claims or people that are sick, what they'll find is they can do the health underwriting, but then they'll come back and get a very high rate, and they'll decide not to go with the self-funded option because it's cheaper or less expensive to go with a non-self-funded option. So anyway, we see United Healthcare, we're one of the few brokers that can sell the United Healthcare self-funded plan. Cigna, John Alden, Starmark, and now Aetna's going to start offering a self-funded plan. So this is more and more options, and this is becoming more and more popular. So kind of wrapping up, we sort of talked about the political legal update on healthcare reform. Essentially, to wrap up on that, the Republicans took over Congress, but the President Obama is still in office, so we're not seeing from a legislative perspective a huge change in healthcare reform. There is that Supreme Court ruling coming June, which could really change the individual market, which wouldn't directly change what's going on in the group market, but essentially could really cause some, it would be the impetus for major changes in healthcare reform. That would be the Supreme Court ruling that's going to come out in June. And then beyond that, the major compliance things that are new is this reporting. For groups of 50 or more employees, it's going to be really important to work with us or work with a payroll vendor to get up to speed on how to do the reporting for 2015. So you'll be reporting in February of 2016 for the year of 2015. And once again, that's just for groups that are over 50 employees. And then following on that, we talked about the small group health, the small group subsidy or tax credit through the SHOP. And then we talked about the different trends in healthcare reform, mainly some uncertainties in the association health plan market, small group self-funding, which becomes more and more popular, and then finally the small group insurance exchange, or just basically employers offering multiple options. So, well, I'd like to thank everybody for joining me. I'm going to post this recording onto the onto our your medical benefits. Our medical benefits YouTube channel. And I apologize again for the slides not showing up at the very first part of it. And I also see there's some questions here. So what I'm going to do is I'm going to end the recording right now. And what I'll do is, basically the formal presentation has been ended. And then what I'm going to do is answer some of the